Thank you, Claire, for the opportunity to present today. Today we will be presenting the Best of 529 Essential Seminar. It's a timely topic as we see that so many parents go to great lengths to get their children into school, but sometimes leave that college financial planning discussion behind. With that, today we will be discussing and presenting an overview of college financial planning to help raise awareness and education on this timely topic. 3 topics today, 3 sections: landscape trends and news, which is a high-level overview, and we will be moving through that section pretty quickly over to product training, drivers, themes, and opportunities. 4 years of college, a lifetime of debt. Well, I think that our goal that we will be shooting for is a lifetime, 4 years of college, a lifetime of success, and we will get there together. Jumping right in, rising factors of for importance of college financial planning. Weekly median earnings goes up with a higher level of income, lower unemployment rate. We see that for those with bachelor's degrees, the income levels have been rising faster, while those without college have been seeing flat levels of income. Education is important. This slide provides a chart of the average tuition fees, for students at various levels of schools, whether it be public 2-year, public 4-year, private school. That all 3 have been going up, and for those with public 4 years, it has increased 94%. Of course, it started at a lower base number, but it has been growing quite rapidly. 46% for the private nonprofit 4 years. Education is important, but the tuition level has been moving up fast. And where do we see that number in 18 years? Well, in 18 years, $415,000 for 4 years of private. Me personally, I have 2 children, a 3.5-year-old and a now 9-month-old. And so while that $415,000 is 4 years of private, and that lower number is the 4-year public school, New Hampshire is the most expensive school, so it is a timely topic for me and for most parents out there as well. So there is demand for a solution to pay for these rising levels of cost. So this chart basically compares the change in CPI, tuition, and overall market returns. And it's this first chart that talks about college affordability gap, which is the gap between rising costs and ability to pay, which has been widening. And we can see that in the chart here today, that for CPI, 1.9%. So tuition, so the ability to pay has not been keeping pace. That 1.9% has not been keeping up pace with the rising cost of college, which is 4.5% and 4.9%. What we see here today in this chart, in this slide, is also some inclination of where we could actually fill that gap. That being returns the need to save and save efficiently. 4.7% is higher than 4.5% and 4.9%. Which makes us think that we also need to save efficiently in terms of tax. So, and this is the end result of families not saving and not saving efficiently. That rising level of student loan debt every year. The red bars is the annual increase. It's very consistent, very straight lines. Very easy to see the trend line, especially from a data perspective. But what we have seen as well is that there has been an increase, that student loan debt has been increasing at an increasing rate, so this solution is needed. And what do we see as the landscape trends to close out this, get near to the close of the section about landscape trends and news? College affordability themes today. So we've seen the definition of college financial planning broadening from that saving and paying efficiently to that repaying efficiently as well. And we've seen a lot of news and coverage around the income-based repayment discussion, student loan consolidation articles, lots of questions coming in from accountants and advisors across the industry today on these topics. It used to be that there was a lot more focus on the saving and paying efficiently, and so that definition has been broadening. We've also seen employers get engaged in this college financial planning storyline as well. A number of companies have been providing student loan debt repayment as an employee benefit. We see that trend growing. We do think that will continue to grow. And to the extent that that's just an indication of of the demand and need in the marketplace, that will be a rising issue. And of course, the media, well, they've been covering this topic a whole lot more recently in the past 3-4 years. When I first started covering college financial planning in a dedicated fashion in 2010, student loan debt was not a topic that was covered nearly as frequently. So we've seen that that storyline pick up much more fast pattern. We're talking about saving efficiently. Well, this chart is our key presentation or slide on the issue of saving. Saving nearly is not happening high enough. That 5% rate that we've been hovering around for the past 15 years now, since 529 really started to take off. So that's a headwind that needs to be improved. And saving efficiently. Well, I mean, so this data comes from our annual survey of parents, which asks, which of the following types of accounts are you currently using to save for college? Select all that apply. Well, we see that the majority of money is currently being saved in cash, which has very low return, especially in the historically low interest rate environment, and whatever is earned is taxed and included at a much higher rate in financial aid, which we will be covering soon here today. We also see 401ks and IRAs being used, which makes us all think and believe that college and retirement financial planning should be integrated, or much more so than it has in the past. That the use of $77 billion being saved right now for earmarked for college and brokerage accounts. Well, that's taxed and taxable, so that's obviously a concern in terms of efficiency. Covered Ls have a number of restrictions on them below, and we can touch upon insurance products being used for college in a different presentation in the future, but some parents, as we see in our survey results, are using that to save for college. 529s are important, and they're very important in the college financial planning process. They help the clients, but they also help the financial planners help their clients as well. These two data points are coming from our annual survey of advisors, and gauging their perception of 529s in college financial planning. And broadly speaking, 529s have been helping advisors acquire clients, but much more so than helping them to retain it. So put differently from a stat perspective, 69% of advisors agree that 529s in college financial planning helps them to retain their clients. So therefore, a very important topic from that perspective as well. So now we jump into the product training and what we will be covering here today. 529 Essential Fundamental Product Training Overview. And we'll be going over those fundamentals. We're going to talk about tax, financial aid, gift and estate tax planning. So at the very base level, what is a 529? A 529 is a tax advantage education savings plan operated by a state or educational institution designed to help families of all income levels set aside funds for future college costs. Right now, currently, there's only one educational institution that is offering a 529 plan, but the rest of the over 119 plans are issued by states. And where does the term 529 come from? It is named after Section 529 of the Internal Revenue Code, which created these types of after-tax savings plans in 1998. And any U.S. citizen or resident alien is eligible to open an account. I think within this statement, one important component is that it is an after-tax savings plan, much more akin to Roth IRAs, where you receive the after-tax payment from your employer, and then from there you contribute into the 529 plan. Two types of 529 plans. There's the 529 College Savings Plan, which allows families to invest funds to achieve potential investment growth to make future tuition and related payments. Much more akin to defined contribution assets, where it is open to market fluctuation, gains that are open to market fluctuation. Of course, within the pool of investments being assets being invested, that the investor gets to select the investment options offered by the plan. the other type of plan, 529 prepaid plans, as the title and name connotates, allows families to purchase future tuition credits or units at current price, avoiding the risk of tuition inflation. And within those types of plans, it does take out that contribution away from that potential for market fluctuation and market risk. Today's presentation will focus on 529 college savings plans, primarily due to the volume of users of 529 savings plans, but also the the number of plans that are still open and available for families to invest in. Much more prevalent 529 college savings plans than prepaid plans. And who can be an account owner? And I guess to take a step back, what is an account owner? The account owner is the person who opens the account with the program, designates the account beneficiary, contributes cash to account, and provides investment direction among the options offered by the program. It is, in some ways, the person who controls the account. And who can be the account owner? Any U.S. citizen or resident alien, no income limits, no age limit for account owner or beneficiary, no time limit on holding, contributions must be made in cash, unlimited number of accounts, and plan safeguards against contributions over a certain limit. No income limits. I think that when I compare 529 to other products, such as Roth IRAs where there are income limits, that no income limit aspect for 529 college savings plans is definitely a benefit. Now, if we look at the no age limit for the account owner or beneficiary, if we compare that to Coverdell's, where age 30 is a very important age for the beneficiary. Essentially, all assets in Coverdell's must be used before the beneficiary turns 30. So obviously, the benefit of no age limit for 529 is very important. No time limit on holdings. Well, since 529s have been been launched, essentially you could be the first account owner, account beneficiary, and just still, hold the assets. You can even hold it, and roll it down from generation to generation to generation. There's no time element in terms of need to use the assets by a certain amount of time, which is, typically in comparison to, required minimum distributions for retirement, or for Coverdell's where there's, certain aspects in there. Unlimited number of accounts. Well, that's another great aspect. So.
Yeah. Paul, thank you. Those differences between accounts are very important. I want to give the word number one. The word of the day is tuition inflation. Again, the answer to question number one is tuition inflation. Thank you, Paul.
Thank you. Tuition inflation, very important aspect, and as we covered in that first section. So thank you, Claire, for that using that word. Very timely.
Mm-hmm.
So, who can be an account beneficiary? So, the account beneficiary is typically the student, because that's the person that has the college tuition or related expenses paid for the funds that have been put into the account. And we'll get deeper into the different definitions, but essentially the account owner can and typically is different than the account beneficiary. That's one of those fundamental pieces to 529 plans. Another piece is that there can only be one account that's the same account owner and account beneficiary. So that's another important piece, because as we said before, that the account owner can have as many, there isn't a limit on the number of accounts they can have, but there is a limit on the number of accounts per beneficiary. So who can be the account beneficiary? Well, it's all the different definitions of family and family members, children, siblings, parents, nieces, nephews, aunts, uncles, first cousins, steps to all these different family members. So it is a family orientated product, but if we think about college financial planning, it tends to be a college orientated goal as well. So we pivot over to the tax section of 529 Essentials, and we talk about money going in, what happens once the money goes in, and how it comes out. So contributions are made after tax, as we covered earlier today, and for over 30 states, the states provide a tax credit or deduction to the account owner on their contribution. So that's how the money comes in after tax, and typically, or many times, there's a state tax component to incentivize families to save for this goal. The assets grow tax-free, in terms of state and federal tax, and when the money is taken out of the account, when it's distributed, those amounts are made federal and tax-free if made for qualified higher education expenses. And for the yes.
Excuse me, Paul. The answer to question number 2 is qualified expenses. Again, question number 2's answer is qualified expenses. Thank you, Paul.
Thank you. Qualified expenses, very important aspects of 529s, and they include tuition and fees, room and board, if the student's at least half-time student. There is an allowance made as determined by the school, how much is allowed if the student lives off campus. Books, supplies, required equipment. What is new this last year is based on the PASS Act that passed, that computers, peripheral equipment, software, internet must be used for education in nature, but those are qualified expenses. There's also a piece in there for special needs services as needed for the student to go to higher education. But when one compares 529 plans to say taxable bonds as was used say 20 years ago, there's a much more comprehensive list of qualified higher expenses for 529 plans. But what happens if the assets are not used for qualified higher education expenses? There's a 10% penalty, and typically, if for those 30 states that provide the tax credit or deduction, typically there's a tax recapture. That should be noted. But there are exemptions to the 10% penalty. Beneficiary passes away, but what I did not cover earlier is that you can actually just change the beneficiary. The account owner has the option to change the beneficiary on most accounts. So just because the beneficiary passed away doesn't mean that there needs to be a distribution from the account. Distribution due to disability, or attends a U.S. military academy, and there's a whole list of other ones listed below. This, as does another common question: what happens if my child gets a scholarship? Well, you can still get the money out of the account, and you don't pay the penalty. You do pay state and federal tax on the gains portion of the 529 assets. So if anything, not only is it not bad to open a 529 plan, even if you think you're certain that your child will get a scholarship, because if not anything else, you get the state and federal, you get the state tax incentives, and you get deferred growth. Distributions that can be made. 3 main locations that the distributions are made: to institution, account owner, beneficiary. 1099-Q is still received. Typically what is recommended is to make that distribution to the institution, because that way it's a little bit more easy to confirm and cleaner in the paperwork side to say that the money was used for tuition and higher education expenses. So what happens if you distribute too much? Well, you can contribute the money back into the account within 6 days. No penalty, no tax impacts. You can put your money back in, so the money can be put back into the account. It is worth noting that the calendar year of the distribution needs to take place. I mean, the distributions need to take place in the same calendar year as expense. Obviously the academic calendar is different than the physical calendar. So that's an important item to note.
And Paul, that's a really good distinction to make. And about that, I understood that you can take out of the 529 the amount of, let's say, scholarship or military free tuition that you would have paid if you hadn't had the scholarship. Is that right? In other words, if your kid gets a $10,000 scholarship, you can take out $10,000 from the 529 because the school would have cost $10,000 more.
Right. Yeah. I mean, it essentially it's you know, the impact of various types of scholarships. I mean, it's not, you know, it doesn't negatively impact. If anything, you get, you know, tax-free deferred growth. You know, and you get that state you know, tax benefit, you know, on the money in. So you know, that I think you bring up a very good point that shouldn't be something that holds people back from saving for college.
Yeah, and so let me give you the answer to question number 3. The answer to question number 3 is distributions. Again, distributions, answer to question number 3. Thank you, Paul.
Thank you. So today we'll also focus on the federal formula for financial aid. It's a standardized formula, and it's applied to all applicants seeking, you know, federal financial assistance. Cost of attendance minus expected family contribution equals financial aid eligibility. Parents' assets is accounted up to 5.64% in the financial aid award or awarding process. 529 assets with parent as the account owner and the student as the account beneficiary are assessed at the parent's asset rate. And there's no impact on the EFC when the 529 assets are distributed. I think another great point is that it you know, it reemphasizes the impact of the importance of 529 plans from the perspective of you know, 529 assets in 529 assets and Coverdell assets are counted at the parent's rate, which is at 5.64%, where for the assets in the trust is accounted at 20% of the student's assets. So money in savings accounts and other forms of assets. So if it's a money market within a trust, that's all the student's assets, and that's that impacts the EFC at 20% rate. 529 assets, 5.64% when the parent is the account owner. One question that comes up quite frequently is the impact of grandparents. In the last slide, we saw parent assets, parent income, student assets, but then there's the question comes up quite often, what about grandparents? Well, and other third parties being aunts, uncles, etc. Well, and typically that comes up because it's 0% of income and assets are included in the federal financial aid formula. However, when withdrawals are made, they are considered as student income, which is accounted at 50% of the assets. So for, let's just take the example of, you know, $10,000 being saved. The parent is the account owner. That increases EFC by 5.64%. Well, if the grandparent or aunt or uncle is the account owner and they have $10,000, well, you know, when that distribution is made, the next time they file the FAFSA, that assets you know, are included as student income, which, you know, increases EFC by 50%. So lo and behold, make the parent the account owner. Transitioning over to estate and gift tax. Well, there's a couple different 529 you know, components to you know, gift and estate tax. Well, you know, 529 contributions are excluded from the gross estate. You can even though you gift the money away, you can change the beneficiaries. In contrast, for trust, you typically can't change the once you give the money away, you can't change like who you gave the money to. For the gift tax perspective, you can give there's a 5-year election clause where you can get that $14,000 amount allowed per year in a 5-year in one lump, in one lump for 5 years. So $14,000, you can give away 5 years at one time, $70,000 for a single tax filer, $140,000 for a married couple, and that is per student. So if you have 2 children, multiply it by 2, and so forth. So we move over to the drivers, themes, and opportunities. 529s have been successful to date. $253 billion in assets as of 2015. Prepaids accounted for $23 billion. 12.7 million active accounts, and roughly 8 million households. Hurdles to consider, for why parents are not saving for college at all amongst any vehicle. They just can't afford for college, and that's somewhere for the accountants and advisors on the call can help their clients in terms of budgeting and cash flow. Expect scholarships or financial aid to cover the cost. Well, that's just a myth because it happens at such a low percentage. And if anything, we covered earlier that there is no negative impact to starting up 529 plans, because if anything, you get the benefit like state tax benefits, and you get tax-free and federal tax deferred growth. Other things, goals get priority over education. We talked about the importance of integrating the conversations between college and retirement and other pieces, and don't know where, again, I think that's another example where you can provide value. So we're making legislation. Representative Jenkins and Representative Kine introduced a bill earlier this year that will make, provide incentives for employers to provide 529 plans for those with corporate clients. That could be something where you could bring it up. Because as we mentioned before, that the more and more companies are adding college financial planning as a benefit, more and more flexibility, and for 529 underlying rollovers between 529 plans and ABLE accounts, which are used for the disability community. Very similar tax structure, just different qualified expenses. Another part of this bill is expanding qualified expenses to pay for student loans. We also talked earlier about how the conversation is being made from saving, paying to repaying. So obviously that bill is aligned with that trend. Charitable donations, and increasing the number of investment reallocations allowed per year from 2 to infinite, just to be aligned with other types of investment products. So today we talked about landscape trends, news, some product training, drivers, themes, opportunities, have the college financial planning discussion today, and together we'll get to 4 years of college, a lifetime of success. A couple different resource points going forward. 529-newsletter, that's what we create. Feel free to subscribe. It's free to subscribe. IRS, SEC, FINRA, MSRB, all with incredible pieces, including the Department of Education. One piece that could be very helpful is the 529 plan disclosure statements by the product providers, because there's a lot of information and detail in those that would provide sometimes unique functionality for the plans. And here is my contact information. If any questions arise, feel free to contact myself or Claire. And thank you so much for the opportunity today. Together we will find a way to help more and more families save efficiently for college. Thank you.
Paul, thank you so much for an incredibly dynamic presentation. I need to give the answer to question number 4 is grandparents. Again, answer to question number 4 is grandparents. Paul, thank you so much for these resources and for giving us a really good rundown on the 529 plans and how financial planners can use them to help their families better pay for college. And really it's all about planning. Planning and planning. That's what we do on the admission side, and I think the financial aid side, the financial planning side is really just as important, because so many people, so many students drop out of college because their parents can't afford it. So 529 sounds like a pretty good vehicle for funding. Thank you so much. And again, as Paul said, if you have any questions, please call Paul. Or Paul, can you pull up your contact information, your last slide, because I'm only seeing the resources.
There we go.
There you go. Okay, or call or email me at claire@eduav.com. Thank you so much, and the broadcast is over. Thank you.